I think all the undercurrents that you would want for gold to continue going higher, I think we easily, will break through here in the first quarter through the 2100 area. And then that's going to just bring in a whole different type of investment mood for gold. I really think there's a very strong chance. It was a target I started with 7 years ago when it was down at 1300. I said gold can get to 2500, and I still believe that's a reasonable target that may not come this year, but certainly within the next 1 to 2 years, I think is very viable.
Renowned market commentator Peter Grandich from PeterGrandich Co. shares an optimistic outlook on gold. Grandich foresees a probable $2,100 per ounce breakthrough in the first quarter, anticipating a transformative shift in the investment landscape for gold. Gold has maintained a sturdy position above the $2,000 per ounce mark, garnering interest below this threshold in mid-December. Despite facing a comprehensive rejection following its surge above $2,100, the charts indicate a trading pattern resembling a triangle. Conventionally, such patterns suggest a higher likelihood of price breaking to the upside, mainly when initiated from below. This potential upward movement gains significance, especially in light of expectations that the Federal Reserve might initiate rate cuts in March, a sentiment currently favored by traders. Grandich further predicts that within the next 1 to 3 years, the BRICS nations may introduce a novel currency or trading system, substantiating this expectation with their proactive gold acquisitions, particularly notable in the cases of China and Russia. Recent data reveals that China, a member of the BRICS bloc, added 9 tons of gold, equivalent to 290,000 ounces, to its reserves in December 2023 alone. Russia, India, South Africa, and the fellow BRICS nations have consistently been augmenting their gold holdings over the past 14 months. A pivotal development for BRICS in 2024 involves establishing its currency. Pursuing a BRICS currency is not new, with the bloc expressing a keen interest in developing a currency aligned with local counterparts, steering away from dependence on the US dollar. The bloc emphasized that a BRICS currency enhances payment options and diminishes vulnerabilities, offering a clear departure from the greenback in their trade transactions. Before you watch Peter Grandich's interview, subscribe to our channel and give this video a big thumbs up.
Moving gold forward, I think the additional now that's come into play obviously is the geopolitical factors, not only because the Middle East, as we speak, it is a tinderbox. There's just no way you could put your head on a pillow at night and just say, listen, there's no chance I can wake up tomorrow and be in the middle of a major war. There's that many potentials there. We also now are going to have a uniqueness of what's going to happen with Ukraine. It's obvious now that the will of, at least in America, is not to keep supporting it in the way that it was. Without America being a major supporter, can they continue their fight? And then, of course, there are a lot of other political issues. And again, the single biggest one, and I still say it, and every month I get more bolder because it looks more appropriate to be this way, and that is the coming formation of the BRIC nations, realistically, with America looking out, looking in. This is not really something where a lot of other Western worlds are going to be economies hurt in the manner that the U.S. is going to be. And I think it was extremely critical, and I think Wall Street has paid little heed to it and will regret that they did on how important that is. And there's no question, someday soon, in the next 1 to 3 years, they are going to introduce some sort of special currency or way of trading that'll be away from the dollar, which they've already been doing, but I think it will become more formal. And it's going to involve gold in some way. That's the only reason for why they have been such aggressive purchases, particularly China and Russia and all. And they continue to be. And so I think all the undercurrents that you would want for gold to continue going higher, I think we easily, will break through here in the first quarter through the 2100 area. And then that's going to just bring in a whole different type of investment mood for gold. I really think there's a very strong chance. It was a target I started with 7 years ago when it was down at 1300. I said gold can get to 2500, and I still believe that's a reasonable target that may not come this year, but certainly within the next 1 to 2 years, I think is very viable. I don't think the Federal Reserve is in the mood to raise interest rates much higher because there's so many worse issues for them the higher rates go than what it may help on the inflation side. But at the same time, I don't think we're going back down to zero or near zero interest rates again. And I think that's the big change for people. And I think the big change also, excuse me, is that they're not going to be the rescuer that everybody, or what the Fed put used to be called, that sooner or later the Fed just opens up the spigot, prints all sorts of money, and stocks can only go higher and higher. I think that'd be the big surprise if we speak this time next year, that the Fed did not get into an extremely accommodating position. But I also don't think that they have much left, if at all, on the interest rate rise. What's going to play a role here, and it becomes very difficult for the Fed to walk that tightrope, is the political picture is really going to take hold now in a couple of weeks here in the U.S., the presidential race. And it has all sorts of asterisks that we never had before. We have one guy person's leading that's been indicted in 5 different states. We have the other party guy, no one even knows if he can get himself up in the morning anymore. And we have a whole bunch of other issues that are pending that just make this political environment just so challenging, the debt issue and the immigration issue. So I don't think the Federal Reserve is in a position to be tremendous tighteners, but I also think it would be a mistake to think they're just going to become loose as a goose and just go back to printing money like there's no tomorrow.
Peter Grandich highlights a significant shift in the junior market, noting that financial advisors, once crucial to its dynamics, are now scarce. As a result, junior resource companies need to connect directly with individual investors. Despite a global demand for metals, the junior market is grappling with challenges, leading many companies to opt for mergers due to financing difficulties. In this evolving market scenario, gold miners have recently hit fresh lows in 2024, with additional breakdowns observed. The decline is unfolding as anticipated. Notably, senior miners, represented by the GDX ETF, have breached and closed below the rising short-term support line, confirming a bearish trend. Having already experienced a very short-term breakdown, junior miners have now approached the lower boundary of their rising trend channel. While a momentary pause or a modest rebound might be expected given the current setup, a decisive breakdown and a substantial move lower wouldn't be surprising. This aligns with the overall medium-term downtrend observed in the miners market. Let's get back to the interview.
Well, the good news is I've been able to manage to wipe off all the blood that I suffered from the hardcore bear market we had. We had the worst bear market in the 40 years that I've been around them. I think there's some important changes if you're going to play the junior market to appreciate. I knew of them last year, and I still went against them, and it was costly. I don't think the junior market is what it was 20 or 30 years ago. I think it has stiff competition now. There's a lot more speculative ways, and the single biggest one, obviously, is cryptocurrencies. There's no question about it, whether you're bullish, which I'm not, or you're bearish, which I am, that cryptocurrencies and the interest in them, particularly as you go down the scale of people's ages, clearly took away money that otherwise would have found itself into the junior market. The second thing that I think that happened in the junior market is become very difficult to be a miner, to explore. I like to say that 30 or 40 years ago, you and I could have spun a globe, let our fingers land anywhere. We wouldn't have a difficult thinking we can go to that country and go exploring. That's not the case anymore. It's really shrunk dramatically. And quite frankly, it's going to take a lot for majors, especially when you start seeing countries like in Panama and all, where in a sense they've taken control or nationalizing mines, that they're going to go on and go out and spend a couple $1 billion to build something that may not be theirs in a year or two. So I think those two things, plus the regulatory, juniors are always mostly hopeful. We're hopeful to find something. We hope that this deposit may turn into something. And yet it's become really difficult for the marketer. The people that used to be available that played the junior market, you would go, you're going to have a great show up there in Vancouver in a couple of weeks. And there would have been years ago 500 to 1,000 brokers there, or now called financial advisors. And they all had books of businesses where they were buying and selling juniors for their clients. That's basically a dinosaur. There still may be a handful of financial advisors that buy and sell junior resource stocks for commissions, but that's really come challenging. So now that junior resource company, who used to get 300 or 500 clients when they got one financial advisor interested, has to get to those 300, 500 on a one-to-one basis. It's much more challenging to be in the junior market these days and all. And I think also, Charlotte, that because of how severe the bear market was, we're going to see, and we're already seeing it, a lot of mergers out of necessity. Juniors are just not able to fend for themselves anymore, and financing still a big challenge, even though we lifted off the lows towards the end of the year. So I think the market's more challenging. And what's ironic about it is it's at a time when we have such a big need for metals. We used to live in cycles in the junior market anymore. There are no cycles. We have far more need for metals than that's currently going to be available. And that's in a wide range of metals. So it's the best of times, but it's also still some of the worst of times for the junior. And that's why I still don't think, although we're off the bottom, I don't think it's going to be a rocket shit straight up, because we're going to need to go through an M&A period where there's some consolidation in the industry. And that'll also be up in the smaller producers kind of merging together to become bigger ones, because that's the only way they can attract institutional investors now. So it's far more challenging than it was 20 or 30 years ago.
If gold continues to be seen as a safe investment, there's a better chance for its value to go up. Some experts believe that if the Federal Reserve, Fed, makes 4 interest rate cuts this year, starting in June, and a total of 200 basis points by 2025, it could positively impact gold. Looking at past instances since 1990, on average, gold has been 6% higher 30 days after the first rate cut by the Fed. Will gold's potential to benefit from a haven premium make it an attractive investment in the coming months? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. We aim to reach 5,000 subscribers as soon as possible, and your support could make a big difference. Thank you for being a part of our community.